All right, I think we're live on Facebook. Those of you that are joining, make sure you mute yourselves, please, if you could. Let's see here. There we go. Jeremy, Michael, welcome. Jim Walsh, welcome, sir.
Hey, guys.
Good morning.
Happy Friday. Let's see. I'm going to start with, I'm going to jump right into this. I'm going to share my screen. So for those of you that have not gotten, and a lot of you will be watching this later on Facebook or YouTube, but for those of you that have not received a monthly newsletter from us, I'm going to show you what they look like. You guys see my screen that shows the newsletter okay?
Yes.
Perfect. So should look like this. Any property that you own with us, this one's Fairmount 4. You should have received an email today from us, and it has some KPIs. Some of them are different than others. Right now, we're working on remodeling Fairmount 4. We'll be there on Monday. Big highlight is cash flow is starting July 1st. So that's exciting. And then Naveen asked, how do I set up the cash flow? That's a great question. We are reaching out to all of you to make sure your ACH deposit information is set up correctly. So we're doing that this month, and Jeremy, Lyndon, Calvin are going to be helping me do that, as well as Tien, I believe, and probably Yen. So we'll have a team on that, everyone making sure that that's all done correctly and ready for that initial cash flow. The other questions I'm receiving are how much is it going to be? And it'll be 6% of your investment for 1 month. So if you invested 100,000, 6% on 100,000 is 6,000. Divide that by 12, that's 500. So you should have about a $500 deposit based on a $100,000 investment. And then moving forward, it'll most likely be really close to that. We are remodeling a lot of units, so it could be less. Michael, Jeremy, you guys have been on those calls with me. We may decide to distribute less if let's say we have 60, 70 vacancies at the time to preserve some cash in the bank. We may decide to do that. So just keep an update on that, or keep an eye on that when we send out those updates. We hope it's close to that 6% that we are trying to hit in the first year to 2 years during remodel, but totally depends on how many units we can fill based on how many we finished. So anyways, check your emails, take a look at these. You can also look at photos. And then next week, while we're there, we will be actually sharing a ton of videos and pictures. We'll have our photographer and videographer, Eric, there, and he'll be taking photos and videos of the finished units under remodel. And we're really excited to show you guys that. So for those of you watching, today's June 3rd, we'll be there on Monday and Tuesday. So be aware, looking out for those photos and videos. And then of course, if we're friends on Facebook, I'll do some Facebook Lives that you guys can take a look at. So other thing that's, one sec, let me, I think this is probably what you're going to talk about, Michael. One really cool piece of information is that our lender visited the property at Fairmount 4, and they were ecstatic about how it looks and the remodel process, how that's going. They said, hey, you're really doing it. This is cool. We really like the finished product that we're seeing. So just wanted to shout out to Nadia and all of our team working on the remodel process. That's really big news and really exciting news that the lender loves that. And we love it too. And I'm excited to see it in person. Michael, go ahead.
I was just going to share with people in case they're wondering, in June and July, maybe a certain part of August, we're going to have a lot of people moving out also of that property, which was completely planned, completely expected. So we expected a large dip, at least temporarily for a couple of months of occupancy, which gives us a chance to then go in, do all the remodeling, have it ready, really ramp up August, September, October to get those re-rented at a much higher rate and get that NOI as high as we planned. So I just want to make sure people were clear about that. It was all planned.
Absolutely. Yep. Seasonality as well as planned vacancies to remodel units. And that's why we told everyone cash flow would be low the first year to 18 months, because this is a big lift. This is a heavy lift. but that's also why there's so much upside. So the other side of that is, we were expecting $1,200 a month in rent, average rents, and we're really realistically looking at a lot more than that once we finish this project. So we're pretty darn excited about that. Let's see here. So we'll be there the 6th, 7th. We'll send you guys updates on Fairmount 1, 3, 4, Lakewood, and then of course our next purchase, Fairmount 5, which we're really excited about. We will start accepting money and reservations for that in the next few weeks. And same type of property, 1.5, 2 miles from the Cleveland Clinic, and amazing renter demographic. We love this area. I was talking to someone yesterday, Michael, the gentleman I know that owns 7,000 units. And he said, hey, I've been really interested in Cleveland in general. Tell me about this Cleveland Clinic area that you're in. And I said, well, don't go there. It's terrible.
You'll hate
it. I said, we're losing a lot of money. Don't go there, please.
It's the worst.
He's got some serious buying power. He has to place $55 million in the next 6 months in 1031 exchanges. And I said, no, but in reality, I said, the renter demographic's amazing. And he said, no, we love anything that we have close to hospitals and medical schools. He said, we do really well on. So he's like, that's smart of you guys to target that area.
Tell him for 60 million, he can have the whole portfolio.
Yeah, exactly. Yeah, we'll sell it to him at 160 a door.
Yeah.
Double our money.
Yeah.
So, no, yeah, it was interesting hearing a perspective from a guy. And it's funny, we actually went to high school together. He has partnered with some venture capitalists and some big money out of San Francisco, actually, and they are targeting tertiary markets. So they really like South Dakotas, the different areas in Texas that are a little bit smaller. They really like, the different areas like Boise, Idaho, or Idaho Falls, Idaho. And they're finding it tough to find yields. And so they're avoiding the hot markets like a Dallas, which we've done amazing in. They're avoiding some of these bigger markets because they want to hit some really high returns. They want to hit 20% IRR. And so it was interesting hearing the markets that they're moving into and doing very well in. So that was a fun conversation. But as far as an update on the rest of our portfolio, if you guys, again, did not receive a newsletter from us today, please reach out. It means you probably have us blocked on spam, or it's going to spam, or for some reason it's not going to your email, because I do have everyone's email in the system. So you should have received that email. We should have distributions going out. So if it's going to the wrong account, I know Annabelle and a couple of you wanted us to change the account that it goes to. Just let us know. We'll be happy to work on that. Another big question that we got from Wayne and a few others is, when is the cash flow going to equalize and just be the same every month? And the answer is never for some of the properties. The El Paso property, Dallas property, the first Cleveland property we bought, we didn't do a preferred return because they were heavy lifts, and there's a lot of unknowns. And so every time we do a cash flow distribution, it's based on that month's current occupancy. So it could be 96 this month, could be 95, could be 94, could be 98. Like Fairmount 1 is 98% occupied right now. So the answer to that is, unfortunately, we are not going to have a lot of consistency, because we'll have one move out, two move outs, or we'll be remodeling a property or a unit, and that will be changing every month. What we did want to do is make sure you guys got cash flow every month, and we're probably going to be switching that to quarterly, so we can have a little bit more consistency. So if we calculate the distribution over 3 months rather than 1 month, we will have a little bit more consistency. So that on future deals, to help you guys have more consistency, to help us have less brain damage calculating these returns, these distributions, we're probably going to move to quarterly distributions. And Michael, that's something that you and I wanted for our investors, as far as monthly distributions. And all of these sophisticated, high net worth, large portfolio managers all do quarterly for that reason. They said, we want to provide more consistency, and just the numbers are easier to do it quarterly. So I think we're going to start moving towards that, per request of a lot of our investors, and per the recommendation of some very large asset managers in the 6, 7, 8, 10,000 range. So anyways, that's something that I wanted to update people on. And Michael, any thoughts on any of the other properties, any other things that we've been talking about recently?
This is going to sound a little bit different, but you don't want to have it when you're buying add value properties. You don't want to have consistency. If you have consistency, that's actually a very bad sign. You want to see progress. You want to see some ups, some downs, at least temporarily, because that means that those downs mean that it's opportunity to go in, redo those properties, get that rent jacked up. So eventually, it's going to look more like this, but it's going to keep going up. It's not going to be this or this, but you're going to have some dips. Then it's going to keep rising. So, like for example, our property in El Paso or our property in Dallas, not Terrace Hills, but Desert Peaks and Meadow Creek. When we first bought those properties, the NOI was what, $100,000. Well, now the gross monthly rentals were $100,000. Well, now they're $130,000, $140,000, $150,000 in only 18 months, which is, I don't care how you slice it. That's a hell of a thing. So just so we're crystal clear, we're not buying A-class trophy properties where you give us $10 million and you get 5% for the next 10 years, and it's just anemic. That's not what we're doing here. So I just want to make sure we're clear about that, so people's expectations are managed.
Yeah, absolutely. It's really important that we're doing a lot of work, and we're barely halfway through the remodel process on a lot of these properties. I did want to show some pictures of Dallas. The email that you guys got, the newsletter, has a link to all of these pictures in it. Did want to show it to a few of you to show you how amazing it's looking. If you remember the before pictures, this was a rough looking property. It was not sexy. It was the opposite of sexy. It was really tired looking. And now it looks so much better. For a B class property, it looks amazing. And we look a lot better than the property across the street. They chose some weird colors. I would say they failed. They spent a lot of money to paint their property some weird colors. And our tenants love the new paint job. They love the way the patios look. The landscaping's looking better. And so that's the other thing is, as far as cash flow goes, we're barely halfway through the process. And so if investors are saying, hey, we're hearing about all these high rent amounts, but we're not seeing a ton in cash flow, well, yeah, it's because we still have a huge amount of vacant units that we're remodeling. So while we are getting much higher rents on a per unit basis, the total gross income hasn't moved up a whole lot because we still have to finish a lot of the remodels, and we still have a lot of vacancy. And so just like our models showed us, just like we told you guys when we were buying these properties, cash flow will be fairly low the first 2 years as we finish these projects. Year 3, expect that cash flow to go way, way up as we finish the interior, exterior renovations and get most of those units up to that higher rent amount. And so Dallas, it's already performing amazing though. Michael, you remember where cash flow, you just mentioned it was like 114,000, 120,000 just a year ago. Just in 1 year's time, we've increased by almost 40%.
Yeah, you can't argue with that. You can argue with a lot of things, but our major challenge now is not filling the units, is having enough units ready to be filled. The demand across the board of the portfolio absolutely has saved us. I don't even say that's not the right phrase, save us. It's exceeded our expectations. So if we were expecting a 20% bump, we're getting 30% bumps or 40% bumps. And we just couldn't be more pleased in that. We have the F5 property that is going to have some high occupancy in the next couple of months. But guess what? I can't wait. None of us can wait till September, October, when those rents jump from what, $850 a month to what, $1,400 a month, Sam?
Yeah, it's crazy.
It's going to be stupid. Yeah. But again, we control the neighborhood, we control the area because of scale. The demand is incredible, and it's right on plan. So.
Yeah, it's fun. I'm really excited to go to Cleveland, and so we'll be shooting a lot of video there, and I'm really excited to show the finished product. I'm really proud of this Dallas property, the way it looks. It looks so much better than it did. It's a different property. And I'm sure the tenants, oh, you can kind of see in this picture, let me reshare my screen. You can kind of see the weird colors they chose at the neighboring property. They chose like a weird blue and a white, and in person, it looks kind of goofy.
It's totally goofy. Yeah.
They may have repainted it again since I was last there, because they had a weird red color as well. And I mean, it's a nicer property than ours. They have covered parking. They have a nicer pool, clubhouse, a little bit newer units, but they really made that place look goofy. So let's see, how do I stop my share? Okay, so cash flow will be coming out. We are working on that system, working on getting a little bit more consistency with those distributions. Lyndon and Jeremy and our CFO are working hard on that. One thing I did want to update you, Michael, and the rest of the team on. I already sent you guys a text this morning. I was on the phone this morning with our SEC attorney. And one big thing for me is that you guys get a bunch of tax write-offs if you can. These passive write-offs as much as possible. And as a GP member, a general partner, I don't want to take those from you guys. First of all, it's really complicated if we do. I just don't want to do that. But second of all, I really want you guys, when you invest money with Multifamily Investment Club, I want you to know it's a conservative deal. It's going to cash flow. Long term, it's a really good hold. And also up front, there's some really nice passive tax losses. And so we changed the way that we write our private placement memorandum. Those are the subscription documents that we file through the SEC. And this morning, I asked them to make a change so that the passive investors get 100% of those tax write-offs. And so when I invest in my own deal, of course, I'm going to get tax write-offs when I invest my own cash. But as a separate general partner, I don't get any additional tax benefits because we're trying to give those all to you guys to reward you, incentivize you, and just help you have another benefit of investing in these multifamily deals. And, who knows how much longer Biden and that administration will allow us to use these tax write-offs. But for now, we want you guys to take advantage of those. And we are working with CPAs and accountants to make sure that we're up to speed on all the tax law changes and different things that are going on. But that's one thing that we changed today with the SEC attorney for Fairmount 5, quarterly distributions as well. Geez, I think that was it. Trying to think of the other questions that we got. Oh, Michael, you and I wanted to talk about working with investors to talk about their investment goals. We've had a couple really cool calls. One of them, David Aristamian, a couple other people that we've called and talked to about, hey, what's your monthly passive income goal? How much have you invested so far? Are those investments doing? And in what time frame will you be able to hit that passive income goal? For David, it was like 3 years, 3 to 4 years with how much he's invested. Some of you are, 15 years out, 20 years out. Maybe you want to speed that up. And we are absolutely willing to take the time to go through all the different calculations on an Excel and figure that out for you and help you understand. And Michael, Chad was a really good example. Chad's story. He said, hey, I want this much, but he's been investing this much. And he said, oh, shoot. Well, hey, I can hit my goal in 2 years if I invest this much. Every deal you guys do, basically one per quarter for the next few years. And he really changed his investment strategy. I mean, complete 180. And, he and a number of other investors told me as well, hey, we're pulling all of our money. I don't know if Chad said this, but a couple other investors said, we're pulling all our money out of the stock market. We're getting crushed and we don't get tax write-offs. And so we love having those conversations with you guys. And the offer is still out there. And so Michael and I will be reaching out to have more of those conversations. So far, the few that we've had have been really beneficial for us to understand and really beneficial for the investors to change their strategy a little bit. Grace saying, oh shoot, I was supposed to send her a text, just remember, but Grace saying she has some money coming in from a couple of her properties that she's selling. And we did a whole strategy. She's going to be able to retire in a few years, a lot sooner than she thought. And if she wants to travel the world with her girls like she thought. And she actually, I helped her analyze, Michael, buying a house in the Bay Area. She said, it could appreciate, it could be a nice savings account for me. I think I want to buy a house for me and the girls. And I said, okay, I understand that. I have kids and I understand wanting to have a home. And so we ran the numbers and it was something like I want to say it was close to an $800,000 difference over 5 years. Buying a house versus investing that money that she was going to buy the house with, and investing it with us. Michael, you've done the same, right? You're renting and you invested all that money, and so far you're doing really well with what you invested in versus buying a house.
I mean, look, it's not for everybody. I'm deeply committed to. Look, it comes down to a couple of things. First of all, we want to know your goals. Why do we want to know your goals? Because every morning, whether they like it or not, my partners and now a lot of our better investors are getting this by me every single morning. I write this on a piece of paper. These are my 10-year goals for what I want for passive income, net worth, what I intend to make per hour, per day, per week, per month, and per year, and then what I want in the bank as a bank balance. And why do I do that? It's because I want to make sure that I'm clear every single morning, what my goals are. And I want the team around me, I want them to hold me accountable and also let them know, hey, here's what I want to do. And here's where I want to go. And I want you guys all to be a part of it. And they want to be a part of it because we're a team here. So that's number one. Number two, as far as taking money out of the stock market and putting it into multifamily or taking it out of a house, you got to decide whether you want to be a trader or an investor. A trader is somebody that basically trades and gambles every day to see if they can make a profit. That's not what we do. These are cash flow businesses. That's basically what you're buying. When you buy an apartment building in El Paso or wherever we buy them, these are cash flow businesses where you have scale, you have cash flow, you have depreciation, you have more control. You're not just hoping and betting that a stock is going to go up or down. So you have to make that decision. It's not right or wrong. It's just a different way of looking at things. Same thing with whether you want to own a house or not. Right now, I'm renting a house for about $10,000 a month. It's about a $4 million house. I came from a $4 million house. Sold the house. I put all the money into our investments. Why? Because guess what? My tenants pay the rent for that house now. It's a gorgeous house in Tiburon, California. 280-degree views, 3,500 square feet, flat acre. I'm the only guy living in it, so it's kind of large for what I need. But what the hell? The tenants pay for it. I don't pay for it.
That's awesome.
So it's just a different way of thinking. It's not right or wrong. It's just we want to know what you want your life to look like. Do you want to live paycheck to paycheck and have to pay, your rent or your mortgage or your car payments from selling a house? Or do you want it coming from your tenants, from your investments? It's just a different way of thinking, not right or wrong, just different. And that's what we're calling you and texting you and bugging you about, to tell us what you want so we can then help you get what you want in the time you want. That's all it is. No more complicated than that.
I love it. Well, Mike Fairyline, we just want to get you what you want in the time you want, and let us help you do that. Love it, Michael. Yeah, and we want to keep having those conversations with you guys. Grace was very grateful, and I'm glad she reached out. I mean, we crunched the numbers, and it was absolutely mind-opening. And she just laughed. She said, "Oh, well, I guess I'm not doing that. That's awesome." And so she's a very smart investor, just like you, Michael. She's done very, very well, and it's been really fun doing those calls. So, Jeremy, anything you want to add? I mean, we're working on a ton right now. Just so many different moving parts, improving systems, which I appreciate your help with. But anything you want to add?
No, you guys touched on it all. I think it's just important to for each person, especially on the call, is just to understand what your goals are. Where do you want to go? And obviously, the three of us, Michael, you, and me, we're deeply committed to this multifamily and growing it, scaling it, and paying out distributions consistently and regularly due to value add. So just figure out what your goals are. And again, you got people around here that are open and ready to help you get there. So don't be shy. That's the biggest thing. We got to communicate at a high level. I will say again, look at your emails, right? The team's working on keeping you updated and really creating a great investor relationship, or even better yet, a partner relationship where you guys are seeing and getting everything that's going on behind the scenes. We literally meet every single morning. And by the way, Michael, I appreciate that little note that you write every single morning, because it keeps me accountable as well, and it pushes all of us to be better. And so you want to be in groups, and you want to be around people that push you, and sometimes even have to pull you along as well. So we're in good position. We're positioning these properties in the right way, and we are in a position to scale greatly, regardless of the interest rate. So I would just urge everybody, keep pushing, be ready, communicate your goals, and we're here to help.
Absolutely. Thanks, Jeremy. I want to end on this note. BlackRock, I don't know if you guys have heard of them. They're kind of a big deal. One of the biggest asset managers, or they are the biggest asset manager.
10 trillion.
10 trillion under management. That's right. So interest rates are rising. We've got a lot of thoughts on what that's going to do. We have massive inflation, and they're doubling down on multifamily. So look, I don't claim to be any sort of genius. All I know is that I want really conservative, high returning investments for me and my investors and my partners. And in an interest rate increasing environment, with inflation, with all the challenges we're having right now with gas prices, you know what BlackRock says, the thing that we want to bet on is multifamily. So if you read this, they are adding.
Sam, can you send that to me, Sam?
Yeah, we'll do. So they're actually targeting Salt Lake City. So house prices are up over 50% in the last 2 years. So what they're saying is, hey, people can no longer afford to buy houses. Perfect. We love multifamily. Let's double down on multifamily. So they have their new BlackRock Impact Opportunity Fund, not their new one, but their BlackRock Opportunity Fund. They just bought 252 doors in downtown Salt Lake, and it was launched last year, and they're still looking for more for 1 billion just in Utah. They want to spend 1 billion.
Sam, what will the return be to their investors on that on a monthly or quarterly basis?
I mean, their cash flow is probably going to be anemic, 3 to 5%,
yeah.
but IRR 15% plus, because they understand what inflation means when you lock in a great asset like the one they bought. I know right where it is, 252 doors. They understand how amazing owning a multifamily property is long term. And as these housing prices continue to increase, more people will rent. And that's why we're doubling down. And, you know, I've put all of my eggs in the multifamily basket because I've seen that and I've studied the numbers. Just like BlackRock is saying, they want to put a lot of money into multifamily because they understand that's the way inflation is pushing people. That's the way gas prices are pushing people. They're not going to be able to put down $50, $60, $80, $100,000 in a house on Utah anymore and get anything nice. So a lot of people end up renting, which is great news for us. So just like BlackRock, we are looking for more value add opportunities. We're looking for A assets like they are. But you know, the numbers don't have to be amazing for BlackRock because they have so much scale. And if they hit 3 to 4% a year cash flow over this time of 5 to 10 years, they're still going to hit 15% plus IRR. And that's all they need. You know, that's still beating the market by double.
Yeah, you're buying when you're doing a Grant Cardone thing or a BlackRock, they'll do a wonderful job, but you're basically buying a bond. It's a very different model than what we're doing. What we're doing is we're buying in great cities as well. We're buying add value properties. So they're just buying properties that are trophy properties. God bless them. They're great properties, great locations, but the upside is not going to be anywhere near what we're doing. So you can have it both ways. You can buy in great locations like we do, whether it's Cleveland, El Paso, Dallas, Tampa, New Mexico, wherever it is. Those are all great locations. But we're not looking for that trophy. We're looking at properties that with sellers that have not raised rents for 5 or 10 years. They want to get out, they're tired, and the brokers know that we will perform. So that's the thing. I mean, God bless BlackRock, but that's not a model we would normally buy because there's very little upside, even though they'll still do great.
Yeah, they're going to do. Their
their
investors don't need
care.
cash flow now. They need
Right.
net worth growth,
Right.
and we provide both. So we like to be right in the middle of both. We don't have the liquidity BlackRock has, so we still need monthly cash flow. Especially if the economy takes a turn. That's the beauty about these value add deals. They have a lot of wiggle room. So I just love that BlackRock is paving the way for us. Grant Cardone, I mean, what did he say? He just needs another 10 billion in multifamily. I just saw some. I used to think his quotes were crazy, and now I take them serious.
I need another 12. He said, all I need is another 12,000 units and I'm good.
There you go. That's what he said. Just another 12,000 units is all he needs.
And then you know what? Then he'll sell that to BlackRock.
To BlackRock. Yeah, that's his goal. He's stated that publicly multiple times. So, okay, guys, have a good Friday. Have a good weekend, and look for those emails. I know there's a few of you, including Jeremy, who for some reason are not getting them. So just shoot me a text, shoot me an email, and I'll make sure you guys get that figured out. And also check your spam boxes because they could be in there.